Welcome back to another edition of Intelligent Investment Today, the podcast concerned about all things value investment. Each episode we consider different lessons and ideas as laid down by the person widely regarded as the father of the craft, the mentor and teacher of Warren Buffett. We're of course talking about Benjamin Graham. Today's episode is going to be ever so slightly off-piste, in that we shall not be talking about a specific idea or concept. Instead, we shall be looking at a practical example of analysis in action. This will loosely borrow from Graham's general teachings, given that I'm a student of his, but of course we're not talking about an exact science here. So of course my methodology may not mirror exactly that of a fellow student of Graham. Indeed, Graham never laid down precisely the exact form an analysis should take. Rather, he provided the student with the building blocks required to form their own strategy. This is one of the reasons Graham's teachings have remained timeless. For the stock market of today is a very different animal to that of the 1930s and 40s when Graham applied his trade. So whilst the application may have altered, the fundamental ideas have not, and I see no reason why they'll do so either in the future, even with the threat of AI removing the human element to investment. This podcast aims to give you a brief overview of how I approach an investment opportunity on the stock market. In the future, we can build on this with deeper dives into specific stock opportunities, but for now, the basics. So sit back and get ready to take in another lesson in the art of value investment, one that will take you one step closer to success on the stock market. The very first rule that I always set myself before beginning any analysis into a company is that wherever possible, I will avoid looking in advance at the stock price or the market capitalisation. In other words, what the business is currently trading at. I feel that to know the price the market is valuing the company at in advance could, in some way, subconsciously influence my analysis. Only after determining my own independent valuation of the business will I compare it to the market's reckoning, and this will be the basis on whether I choose to buy a stock or leave it well alone. My initial attention will always begin with the quantitative showing of the business. These are the aspects that can be easily counted or measured. Essentially, this means an analysis of the company accounts. It is important that before coming to a conclusion about a business's financial picture, we take into account a number of years. This is because a single year will never paint an accurate picture of a business. One-off events may conspire to make the current year's accounts appear unduly rosy or disproportionately bleak. Taking into account the financial record for a good number of years should better highlight what a normal or typical year for that business looks like. But how far back should we be looking? In an ideal world, I would like to see 10 years of business accounts. Of course, the further back in time we go, the less meaningful accounts can sometimes become. A company may have bought out another business in that time or sold off part of its business, which can sometimes make historic accounts somewhat meaningless as a tool to judge typical earnings. So what I demand is simply enough evidence to give me that warm fuzzy feeling that I can understand what a typical year looks like in that business's life. 5 or 6 years of meaningful accounts may be enough to achieve this state, but just 2 or 3 years would almost certainly not. The idea of looking over 10 years worth of accounts may sound a somewhat daunting task, but the good news is that at this stage of the analysis, this isn't some forensic dive. At this stage, we are essentially concerned with 2 pieces of important information: the business's earnings and its balance sheet, both of which can be typically found somewhere in its annual reports, or its 10K, as it's called in the US. So even 10 years worth of accounts will typically boil down to just 20 pages that need to be studied. When analysing a business, I will always begin with the current year and work my way backwards. The figure that I'm first interested in here is the profits the business has generated after tax. Different countries have different terminology for this figure, but is essentially what profits belong to the shareholders after all corporate taxes have been paid. I'll be making note here of any irregular incomes that are one-off in nature, which will better allow me to understand what a normal or typical year's earnings look like. I should be doing this and making note of the after-tax earnings for each year, going back up to 10 years wherever possible, or until the results are no longer representative of the business's current financial situation. If I deem that I've gleaned enough information from this analysis to allow me to determine what a typical year looks like, I shall then move on to the balance sheet, which is the list of all the business's assets and its debts. This will help me determine the financial health of the business and how sustainable that business is. The balance sheet is an absolutely invaluable document, as important to the value investor as the profit and loss account. For it is quite conceivable that even a business that demonstrates healthy profits over a number of years could prove uninvestable should the balance sheet be majorly out of shape. The reason a balance sheet is so important for the value investor is because it will show if a business has the financial strength to continue to exist should the very worst happen. We can turn to the airline industry as a recent example of why what a business owns in assets and owes in debts is so vitally important and can come to determine if a business can survive any sudden and unexpected downturn. If an investor was examining the income accounts of most airline businesses worldwide in January 2020, what they would likely have seen is a healthy demonstration of profits over a good number of years. An investor who forgot to check the balance sheet, however, would be in for a rude awakening a month or two later as the global pandemic all but shut down the industry. With revenue streams obliterated, in order to survive this period, airlines needed to borrow substantial sums of money. As we know, lending institutions are always on hand to fill gaps in liquidity for going concerns, but there is no obligation whatsoever for them to do so, and they were unwilling to step in to bail out businesses that already owed substantial sums of money. The businesses that were already leveraged to the absolute limit struggled and sometimes failed to find further lines of credit, and as a result, they failed, and their shareholders were wiped out. The pandemic incidentally killed off 64 such airlines, and this is why the balance sheet is so vitally important. It can give you a flavour of how the business will cope in times of severe market turmoil. And let's not forget that severe market turbulence is a regular occurrence in the stock market. In the last 25 years or so, we've had the pandemic, but we've also had the European debt crisis of 2010, the global financial crisis of 2008, the after effects of the September 11 attacks, and of course the dot-com crash. All these events severely altered conditions for a number of businesses, and for those with the weakest balance sheet, it threatened their very survival. A strong balance sheet, or at least one that is not weak, is a prerequisite to any decision to invest in a business. No amount of earnings or profits can compensate for a balance sheet that shows the business to be over-indebted. We shall talk in more detail about what to look out for in the balance sheet in a future edition, but needless to say, wherever accountants are involved, you can expect some degree of financial chicanery. Thankfully, it is generally quite easy to spot and to adjust for. Such chicanery will normally involve what are called intangible assets. These are typically assets that cannot easily be valued, such as trademarks or patents. And because they cannot be easily valued, it gives the accountants the ability to value them to suit their needs. There is also something called goodwill. This is something that is listed as an asset, but in reality is nothing of the sort. Like I say, this subject requires an episode all of its own, but I hope this at least gives you an overview of what we're talking about. The important thing to remember is that understanding what is set out in the balance sheet will inform you every bit as much as to whether you should invest in that business, as does the earnings for that business. Always remember that a poor balance sheet can turn your gold mine into a deathbed, sometimes overnight. The value investor will also be interested in the cash flow account. Although the importance of this document is intertwined somewhat with the income account and the balance sheet. The cash flow account is essentially a guide to how much money the business has to meet its short-term needs. Because the cash flow statement is a snapshot in time, it can easily be manipulated. But nevertheless, a poor showing can raise a red flag that the investor will do best to heed. But unlike with a poor balance sheet, a demonstration of poor cash flow need not always be a precursor of doom. If a business has a decent history of profits and providing the balance sheet is in good shape, poor cash flow need not be an existential threat. Businesses that are in otherwise good shape have open to them lines of credit to balance out any shortfalls in short-term needs. At this stage of the analysis, we should have a fairly robust picture of the business from a financial perspective. And if the business's accounts have been able to provide us with the information we need to obtain that warm, fuzzy feeling that we're seeking, then we may be able to place a preliminary value on the business and its stock. At this stage, I like to forget the fact that I may be valuing a multi-billion-dollar conglomerate and instead imagine I'm valuing a small private enterprise. This allows me to take off my stock trader cap and put on my business person head. I ask myself, what is the most that I would be prepared to pay for this business if I was putting in an offer to buy the entire concern? Let's say it's my local independent grocery store. You don't tend to buy this sort of thing with the intention of flipping it a couple years down the line. So let's set ourselves an investment horizon. I picture that I intend to stay invested for 20 years. So the question is, what return do I deem adequate during that period? The answer to this question will be the basis of what I am prepared to pay for the business and the stock. If I examine the current and past earnings of the grocery store, and there is enough evidence to suggest that typical expected profit after tax is, say, $100,000, then I will conclude that over my holding period, I will earn $2 million. I can then, if I wish, sell on the business for what I paid for it. The maximum figure I will pay for the business, taking into account only the income, would therefore be $2 million, which means if I was to sell on the business for the same price paid, it would give me a return of 5% per year. The important thing here is that we are talking in today's terms. We are not taking into account inflation, and neither are we projecting trends of earnings into the future. That would be in the realm of growth investing, and that is not the business we are in as value investors. We aim to keep things as simple as possible. The other factor that any business person would take into account if considering the purchase of some private business is what comes with it. A business person would clearly pay more for a business that has a healthy balance sheet position than one that has not. So a grocery store with no debts, that owns rather than rents its premises, would clearly be more valuable than one that comes loaded with debts, with little or no assets. A grocery store that comes with a gold bar in the safe is clearly worth more than one without. So the business person may decide to pay more for this favourable position. If the gold bar is worth $200,000, they know how much more they are prepared to pay. At this stage, we have determined what the earnings are worth to us and how much we're prepared to pay for them. And we have considered that the net asset position may alter the price we are prepared to pay for the business if the assets are especially attractive. We now know what we are prepared to pay for the business based on its financial showing alone. We must now consider all those factors that are extremely important but are less well suited to valuation in numerical or scientific terms. These we call the qualitative factors. These may be any competitive advantages the business has, the management quality, prospects for the industry, growth potential, and much more besides. Our aim as a value investor is not to place any numerical values on these attributes, because we know that to do so would be a fool's errand. Rather, we consider their potential to affect the quantitative valuation that we have already arrived at. If, after full consideration of all these factors, we deem that they have a neutral or positive effect on the valuation, we may consider it worth to proceed with our investment. But before we do, there is of course one last factor we need to take into account. One of the very cornerstone principles as laid down by Benjamin Graham. That is, if you had not already guessed, the margin of safety principle. This is a discount we demand on our valuation to mitigate against the chances of error of judgment or against changes in circumstance that are beyond our purview. The margin or discount we demand will depend on our confidence or certainty in our valuation. As an absolute minimum, I will demand 20%. This would be for a business that has a long history of stable earnings, which operates in a non-cyclical industry, that is one not prone to boom and busts, and whose quantitative picture is rosy. On the other hand, I may demand a 50% margin if the business's earnings are more difficult to estimate. This is typically the case for businesses that, through their very nature, are prone to cycles of boom and bust. It is important to emphasise that the margin does not exist as an insurance policy against the risk of investing in poor businesses. Rather, it is there to mitigate against small errors in judgment or the unknowable risks associated with all business investments. From this, I will arrive at the highest price I am willing to pay for a business. I can of course translate this into a stock price by dividing the figure by the number of shares outstanding. Only at this point will I compare my valuation to the current market price. This will determine if the stock is currently of interest to me. And there we have it. It must be said that many analyses will be terminated long before this point, on the basis that I cannot accurately judge what typical earnings look like, or I cannot fully understand something in the business's accounts. And, of course, this is just an overview. There will be other factors I have not described, like reading through the annual report to fully understand where the earnings come from. This, incidentally, can sometimes throw in a surprise or two, like with Associated British Foods. Without reading the report, you might think you are valuing a pure food play, when in actual fact, the majority of their earnings come from Primark, the clothes retailer. An important factor to be aware of, I'm sure you will all agree. As we move on in future episodes to individual analyses of businesses, we shall hone some of these techniques further still. That is it for today's extended edition of Intelligent Investment Today. I say it every time, but please do consider adding us to your playlist and do continue to spread the word if you like what you've heard. I'm David Coombs. This has been Intelligent Investment Today. Until next time, stay safe and happy investing.